Today, I am joined by a preeminent tax attorney, advisor, and lecturer, John Forry. Welcome, John. Thank you for joining me today. And please kindly introduce yourself.
Thank you, Michael, and thanks for having me on your recording. Um, yes, I spent about 25 years with a very large law firm, international law firm called Morgan Lewis and Bockius, and I was a senior partner in that firm in charge of all of the U.S. West Coast, Asia Pacific, and Latin America practices, and spent several years as a partner also with Ernst& Young in international finance and taxation based in their New York global office. And more recently, spent a few years teaching full time in the US, China, Brazil, and France, graduate programs in finance, international finance and taxation and investment policy. So now I'm advising private clients on their mostly international investments and transactions, including foreign investors coming to the US and US businesses going abroad. But of course, what we're talking about today really has to do with the opportunities to generate tax-free capital gains over time. And that often can apply equally to US and foreign investors. So,
What possible thoughts, ideas, uh, mechanisms, vehicles for sellers of primary residence to deal with capital gains and reducing that or deferring them, deferring those taxes? And I'd just like to know your thoughts on it. The floor is yours.
okay, thank you. Now, you did have a recent very good discussion with Adam Barr on a few of the techniques that people use. Also, I want to go beyond simply just the sale of a residence. Beyond that, there are other situations that people should be aware of as to what to do with, for example, the proceeds of the sale of residence. They may invest it in another residence, but whether they do or not, uh, there's opportunities for them to take part of that money and invest it in other tax-free situations. So, of course, we would start basically pointing out the exemption on a certain amount of gains from anyone from the disposition of a residence, their personal residence. Those gain amounts, 250,000 or 500,000 per couple, frequently are inadequate to cover the taxable gain from higher end properties, particularly in a tight market as we have now. As was covered in your previous, you covered several techniques. One is the tax-free exchange of real estate for real estate. Um, that does not apply to a personal residence. It does apply to a residence which has been used for rentals, i.e., business asset. So that's certainly a possibility in the case of that kind of property. Uh, Even in that situation, it should be noted that foreign investors can use many of these techniques. In the case of the like kind exchange, it should be noted that when you have a foreign person exchanging US to US real estate, yes, the qualification for that tax-free exchange does have a couple of additional compliance steps in it. And so people familiar with exchanges know that there are certain time periods, but that have to be satisfied for the exchange to qualify as tax-free. But in addition, where there's a foreign party involved, it's important to have a little extra steps taken because the special regulations in the Internal Revenue Treasury regulations do require some limitations, and then you have to file things to make sure that you've complied with those limitations. I just had a client who didn't do that and tried to, you know, modify things and get them taken care of in time. And they talked to me about what they were trying. They were not doing it in their own name originally. Then they decided they needed to do that. So we did have to go through some additional steps. In addition, a very common technique is to engage in an installment sale. So that means taking back seller financing often. But that can be structured to qualify for installment sale treatment. So deferring the taxable gain over quite a long period could be, certainly it could easily be 5 to 7 years, maybe 10 years. The time cost of money and not paying that tax now definitely is a savings, particularly as interest rates are going up. And also the value of money is going down probably. So paying the tax a few years from now means that it will probably be less of a financial burden than it would be of paying it now. And it's possible to structure the use of that account receivable in such a way that it is protected. It's in a safe place, but the seller may in fact be able to access the value of that note um, with current financing, provided certain arm's length and limitations are put on it, but generally speaking, not limited to what you can do with the money. So that's not the problem. That's a very important opportunity for people. There are a couple of other more elaborate deferral techniques with respect to a fully otherwise taxable sale. They do involve the creation of either private placement life insurance policies, or which are a perfectly legitimate legal way to invest money as well, and others which are a little bit more elaborate beyond that. So I think it's a little hard to go into all the details of that, but by and large, they can be illustrated in a relatively simple diagram with not more than 5 moving parts on it, perhaps. But where there are substantial sums involved and you want to take advantage of those tax deferral techniques, they're available. They're tested and approved and so forth. One of them, for example, as I think it was alluded to in your previous session, is the use of Delaware statutory trust, which is commonly used in various other transactions not related to individuals selling real estate. But it's a very effective mechanism.
And can be applied, John, and can be
yes,
applied.
Absolutely. It's a perfectly fine situation where you have an otherwise taxable disposition. A third, I guess you'd say, alternative besides the exchange and the installment sales is qualified opportunity zone investments.
Right.
The benefit of that is somewhat limited. The benefit on the capital gains tax side is that eventually, in a few years, the capital gains tax has to be paid, except that there's a 10% discount from the taxable amount. So there's some deferral in terms of the time cost of money, time value of money, but not, and some permanent reduction of the original capital gains tax. But the much more important benefit is that those proceeds which are invested in a qualified opportunity zone can be left in there minimum of 10 years. And at the end of that time, if you sell either your interest in the entity that owns the zone business, or if the zone business itself is sold, then all the capital gain attributable to that particular investor is tax exempt. So it's a very, very powerful tool. It's on the appreciation of the assets that has occurred after you made the investment in the QOZ.
Is that taxable, that gain, In the opportunity zones, will those then be taxable?
The gains in the opportunity zone, they will not be taxable. If you
Will
hold them, will not be taxable. The
not.
disposition of that will not be taxable.
Nice.
Now, interestingly, the QOZ operating income from the whatever business is being carried on in there, that's normally subject to tax as you go. In other words, it's either distributed or allocated to various investors, and they do have to pay tax on that. But here's a good opportunity. In fact, I'm involved with some of my family office clients now in this. Inside the QOZ, you may have investments that qualify for tax benefits. In other words, the operating income may be free of tax, or, and I'll mention a few of those at the end here, or the interim disposition of those investments will also be tax-free within the fund. So they won't be adding to the taxable income of the fund during the 10-year period. So those are pretty powerful approaches to take. Once you've already got money into a QOZ, you don't necessarily have to sit still for having all the operating income while you're waiting for the 10-year period to be taxed to you at your ordinary income rates. Now, there are some examples of additional kinds of assets you can invest in, and some of those even QOZs sometimes invest in. For example, one is called an enterprise zone. That is, these zones are established in neighborhoods that have been around for quite a number of years, that have experienced a decline in essential businesses or in quality housing and so forth and so on. And they are geographic areas that are granted special tax breaks, regulatory exemptions, and even assistance, governmental assistance, in order to encourage private economic development in the zone. So these are often set up following a natural disaster, like a hurricane, such as in Florida, for example. So it's a place where funds can be invested, and essentially the tax benefits depend on a lot of things. Operating income from the investment may be exempt from tax. Disposition of the investment later on may be exempt from tax. They're very, tailor-made. There's a federal program for these, which is under a program called the Empowerment Zones. If anybody wants to go on and do a search for this stuff. And also, every state has these kinds of zones. So you can actually look at it if you want to invest in a high tax state like California or New York, something like that. They have such zones available to mitigate tax burdens and regulatory burdens on those investments. A second alternative is to invest in qualified small business stock. Basically, that's what happens there is if you own that stock for 5 years or more, then any disposition gain on it is free of federal gains tax. And that's 100% gain exclusion. And it's not subject to any alternative minimum tax, which is creeping back into our code. But it generally speaking, it covers exemptions under AMT as well.
And what's AMT?
Alternative minimum tax. So you know that's it. Now at least the size of the business must not at the time exceed $50 million, and the business must be conducting an active trader business during that whole 5-year period. It may rise above $50 million after you've invested. That's irrelevant. It's only a question of its level at the time that you make the investment. I think there's probably a couple of more that I want to mention here. I have the papers up here. Yes, you probably, all of us are probably heard about the recent acts dealing with technology and climate change related investments. And there's too many provisions in there They're either part of the Inflation Reduction Act, so-called, which was recently signed into law, or the Infrastructure Investment Act, which was signed last December into law. But when you add up all of these things that are in there, these are incentive opportunities, basically for certain kinds of investments. And these include, for example, tax credits that are directly payable to the taxpayer. You don't have to wait and have a tax liability and then offset the liability against that credit. It's in addition, they're all transferability. They are transferable. You can sell the credits. Okay. There's various kinds of advanced energy project credits, advanced manufacturing production credits, renewable energy tax credits, even tax incentives for decarbonizing automobile and truck fleets. So let me just mention, I think I actually have a little list here. Oh, yes, here we are. So the way to get into that is to do a search on the recent Inflation Reduction Act. You just call that up and it'll point you to some provisions that have to do with tax incentives for investing in certain areas of climate, clean energy, renewable energy, infrastructure improvements, and so forth. Or you can go on to the Infrastructure Act of 2021, which was signed last December. There are so many of these that people conduct whole seminars on them.
Right.
And they're available to individuals. They're available, of course, to businesses and corporations or to investment funds. So frequently you will also, if you're interested in those, you may actually search for investment funds that use or invest in these incentives under those two acts. They're out there already. They're gathering money. The amounts available are about a couple of $100 billion under each act. So these are in the form of tax credits or special deductions, tax-free dispositions, and so forth and so on. There's a very large universe out there now for what we call technology and climate-related investments. Another tool, which I did mention, but I will come back to it now, is life insurance. You can invest in life insurance policies. You can finance most of the premiums, and the cash buildup inside there, even if it's not otherwise tax-free investments, the cash buildup inside that, value buildup as well, is tax exempt because the insurance company and the insurance account don't pay any income tax. Ultimately, depending if the life insurance is actually used to pay for a death benefit, by and large, that's not taxable. Of course, death benefits aren't. If you can pull out cash by way of policy loans, many people do this, of course. The interest rates are very small, modest compared to what will probably be current interest rates otherwise. So you've actually got a powerful tool there, and that has been used in part to create private placement life insurance policies, which are basically tailored. There's certain assets that they invest in, okay, and generally speaking, they're specified in advance, or of assets of that type. So the investor the owner, let's say, the premium payer, may actually okay those things or those categories in advance, and that's permitted. No problem with that.
This is just terrific.
There are also still available what are called charitable remainder trusts, which means you do create a trust, you put assets in there, the basically there are certain purposes allowed for that money to be used, even for the benefit of the family or whatever of the trustor. But generally, what happens then is there's a remainder interest, whatever is not used for those purposes, goes to specified charities or categories of charities. And so there's ultimately the chance, to pay only on what you actually need to pull out and live on, as opposed to everything. You sell it now and you pay tax on all the gain. Well, maybe that's not such a good idea. Make a charitable contribution into this trust, and you won't pay except on things which are actually extracted for your personal use or your family's personal use.
They're terrific, John. These are all terrific. I had a couple of questions, but I'll let you finish.
Let me finish, just because I do have something to point out for foreign owners of U.S. assets. Most of these techniques we're talking about are perfectly available to them. I mentioned a couple of restrictions earlier, but generally speaking, foreign investors, if they're careful to structure their investments as investments in intangible property like stocks, securities, bonds, etc., from U.S. businesses, or even intellectual property, which is not actually used in a business, is just owned by the investor, and registered and protected and so on. Those can be sold free of U.S. capital gains tax. The federal government does not tax U.S. capital gains on intangible assets that themselves, the assets being sold, if they haven't been used in a U.S. trade or business. The business that what you're selling may be stock of a corporation, U.S. corporation, which does have its own business, but that doesn't put the owner into a business. That's a very powerful tool, especially if someone is thinking, has assets, given your situation, has assets and would like to invest in a residence, an expensive residence in the United States. There's a way to get their hands on that money tax-free, and it becomes part of their entire basis in the U.S. real estate. So the amount of potential gain they might have on that, exiting at some point in the future, will be from a very high basis. Gives them a tax-free basis to start. It's equivalent to the kind of rolling over like-kind exchange, but like-kind exchange only gives you your old property's basis in the new property, which may be quite low. This one gives you a high current basis from the beginning.
And this is for foreign investors only.
Yeah, this is for people who are not yet U.S. residents, but frequently they're thinking about being a resident, but they want to go out and buy a house, perhaps.
Right.
They have a chance here to go ahead and realize gains that will otherwise be taxable. Once they've come in, then they're taxed on worldwide income.
These are my buyers, my sellers, and my buyers as well, John.
That's correct.
Great stuff. Couple of questions. I have a couple of questions. First of all, to understand some of these qualified opportunity zones and enterprise zones, they're just good works. They're just good works tax dollars. They're just a terrific opportunities to contribute back to neighborhoods, and a great strategy. I had a couple quick questions. One was, is there a minimum level on some of these programs, or is there a minimum contribution level, or
no? Really? Obviously, if there's not much tax at stake, people won't maybe go to all the trouble of looking at these things.
Right.
But certainly there's no requirement to invest anything more than $1. Right. It's just that the benefit or the tax savings or whatever it is will, of course, be proportionate to the amount that you have invested. Yeah.
And then on those QOCs, that's a qualified opportunity zone. Many of my clients are of elder age. They may not survive the 10-year period. What happens if the principal doesn't survive the 10-year period?
Well, so if the principal doesn't survive, the mere fact that there is a transfer through an estate, under a living trust that becomes an irrevocable trust upon the death of the creator, uh, those are not taxable dispositions. What will happen is
I see. It doesn't
the
pass on, or it
it
does pass.
passes on to whoever gets the asset. That there had to be that kind of exception built in, because otherwise people couldn't control when there might be a taxable event. I mean, it's literally beyond their control. Um, so, and there are some exceptions, if hypothetically the investor declares bankruptcy and the bankruptcy court's in and sells the
I got
holding
it.
in the QOZ, then that is a taxable disposition, but that's not the case you're proposing right now. Yeah.
And last question, I mean, not really a question, but I always think you set it up right to start with, and you have less problems or no problems when you get through these investments and the returns, et cetera. And one way to ensure you do it right is how would somebody reach out to you, John, or reach out? The what you have outlined here is just a the potential for great foundations on deferred tax dollars or use of tax dollars,
Right.
whether deferred or otherwise disposed
That's
of.
true. That's
Um,
true.
and any way anybody can reach
Well, I
out,
don't know whether you
to a
post something
qualified.
about contact info on can you add that onto my, just add, I don't know, maybe you can add the bio
Okay, okay.
onto your screen on this
And what, an
display.
email address is best for you?
An email address is definitely best.
Okay.
Yes, it's really
I think
easy.
I think I have the Gmail, so I could use
Yeah,
that.
you can use that. You do have a 646 area code business phone number for me as well. You can put that on if you